Hello everyone, I am Dr. Soundararaj. I am happy to interact with you through this video. In this video, I am going to explain a concept titled Factors Influencing Pricing Decisions. Please have a look at some of the details related to me. After you watch the full video, if you really like the video, give a like to the video and do subscribe my channel so that you can get the updates of the new videos. Factors influencing pricing decisions. Let's start with a small introduction for this particular topic. Price is the only element of marketing mix that helps in generating income. Perhaps this is the only P among the 4 P's which are elements of marketing mix speaks about revenue, whereas the remaining 3 P's, product, promotion and place, stand for expenses. As one of the elements of marketing mix, price has a significant role in product market integration. Therefore, marketers should adopt a well-planned approach for pricing decisions. What is the meaning of price according to the marketing experts? Price may be understood as the amount of money for which a product or service is made available to people. So if a person wants to buy something in a market, whatever the economic value or the money which he pays to buy what he wants to buy is the price of the object or service. Another way to mean it, price is the total of all the values, whether you pay in lump sum or you pay in installments, or you pay in different forms of the things that have economic value exchanged by the customers just so that they can have or use a product or service. The third dimension of meaning of price. Price is the value a customer pays for in exchange for a product or service. An enormous number of factors affect pricing decisions. The marketer should know the factors that influence pricing decisions before setting the price of a product or a service. So it is wise on the part of a marketer to understand the influences on pricing decision making. A well understanding over the influences and the factors which affect setting price for a marketing offer will enable him to set the right price for the right commodity. Some factors or some influences are internal to the organization and hence they are controllable, while other factors are external, are environmental and are uncontrollable. So the factors which come from the internal environment of a business organization are really controllable by the organization or by the marketer himself. If the factors come from external environment, obviously they are uncontrollable. They are the influences according to which you, the marketer, should adjust your way of setting price. Let us look into the details of internal factors which influence setting price for a marketing offer. These factors play a vital role in pricing decisions. They are also known as organizational factors. The marketer who is responsible to set price and formulate pricing policies and strategies is required to know adequately about these factors. The first internal factor which influences the pricing decisions of a marketer is objectives of the company. Objectives affect price of the product. Price is set in accordance with the general and marketing objectives. Pricing policies must match well with the company's objectives. Your firm may have various objectives and pricing contributes in achieving them. The objectives like earning a market share of 50% or to become a quality leader in the product category. Likewise, these objectives could be achieved well by the company only with the support of a proper price. Firms may pursue a variety of objectives such as survival. What is the meaning of this particular objective? Survival. This is a short-term objective that is appropriate only for companies that are plagued with overcapacity, intense competition, or changing consumer wants. As long as prices cover variable cost and some fixed cost, the company will be able to remain in business. So this is about the survival. In critical situations, companies are forced to set the price as low as possible. Sometimes it's even less than the cost of the product in order to make the product or brand survive in the market in the critical situation. Later, the price could be increased considerably. So this is what about the first objective. Maximization of current profit. To maximize current profits, companies estimate the demand and costs associated with alternative prices and then choose a price that produces maximum current profit, maximum cash flow, or maximum return on investment. However, by emphasizing current profits, the company may sacrifice long-run performance by ignoring the effects of other marketing mix variables, competitors' reactions, and legal restraints on price. So this is about the second pricing objective of the company. Maximization of market share. Firms such as Texas Instruments, a good example that comes to my mind, choose this objective because they believe that higher sales volume will lead to lower unit costs and higher long-run profit. With this market penetration pricing, the firm set the lowest price, assuming that market is price sensitive. So when the market is price sensitive, and you also want to gain the maximum amount of market share, it is wise on the part of you, the company, could set the lower price possible so that you could sell a large volume of units, and moreover, by producing and selling large volume of units, the cost of production per unit will also come down. So this is the idea behind the third point. The fourth one, maximum market skimming. What is this market skimming? Many companies favor setting higher prices to skim the market. This objective makes sense under a few conditions, like when a sufficient number of buyers have a high current demand, and two, when the unit cost of producing a small volume of the product are not so high that they cancel the advantage of charging what the traffic will bear, and three, when the high initial price does not attract more competitors to the market. This is another very important aspect that you should come to know. And the fourth point that comes to my mind is when the high price communicates the image of the product as it is a superior product. And so these are all the points to be kept in mind when you think of the fourth objective, which is nothing but maximum market skimming. Product quality leadership. This is a fantastic idea made possible when your company targets a niche market. A market which consists of a fewer buyers, or buyers who are very quality conscious. The buyers who do not bother about the high price. They are very much concerned about the quality of the product. They want to buy the best quality product, the best quality brand in the product market. In this situation, a few companies that aim to be product quality leaders will offer premium products at premium prices because they offer top quality plus innovative features that deliver wanted benefits to the buyers, and these firms can very well charge more price. The second factor, internal factor, which influence pricing decision is named to be organizational considerations. The philosophy of the person responsible for setting price for a marketing offer is clearly reflected in the form of pricing also. How does he perceive the price? In short, overall management philosophy and practice have a direct impact on pricing decisions. See, it means the person who is responsible for setting price in the organization and the portfolio he belongs to. See, in a given situation, if the responsibility of setting price for a marketing offer is given to a finance guy, obviously he will set higher price. Finance people normally want to maximize profit. Therefore, he will be induced to set higher price. If the responsibility is given to a marketing guy, obviously he will be moving towards setting the lower price possible. In many occasions, he will be interested in setting lower price to the marketing offer so that he thinks a large volume of the product could be sold in the market so that this particular brand will earn a higher market share in the product market. So this will be the influence of the functional area to which the person responsible of setting price for a marketing offer belongs. This is what my understanding regarding the second point. The third point, elements of marketing mix. Price, as we know, is one of the important elements of marketing mix because it is the only P which speaks about revenue to the organization. Therefore, it must be integrated well with other elements like promotion, product and distribution of marketing mix. See, obviously, if you want to come out with a good logic, which is named to be marketing mix by which you want to do business successfully, You should decide about the marketing mix and its elements including price in such a way they try to depend one another, or they are collectively made as a cohesive unit which wherein you find one P supports the another P, and that is how you have to set the price. See, in a situation you can understand that if you have made a highest quality product, your brand is a highest quality market offer in a particular product market, and you also target upon quality conscious consumers. What you are supposed to do with regard to the other piece, you have to set the higher price possible, because many times quality of a product is measured based on its price. It's a belief of many consumers in many product market that if a brand is highly priced, that brand is of high quality. So since quality of a product is measured in terms of the price, when you target upon the quality conscious consumers and want to gain product quality leadership in the given market you have chosen for, you are expected to set a bit higher price for your marketing offer. Then number 3, regarding promotion. Promotion should be done in selective magazines or the television channels which are meant for the high class target customers. That is also to be taken care. And what about the 4th P, place? Distribution should be extensive. When you are dealing with a product which is meant for quality conscious consumers or which are meant for people who prefer your brand as a status symbol, and definitely it should be distributed through the method of extensive distribution, not definitely intensive distribution. So this is what about the meaning of the 3rd point. The 4th point, 4th internal factor which influence pricing decision is degree of product differentiation. Product differentiation is an important guideline in pricing decisions. The product differentiation can be defined as the degree to which company's product is perceived different as against the products offered by the close competitors in the market, or to what extent the product is superior to that of competitors in terms of competitive advantage. The theory is the higher the product differentiation, the more will be the freedom to set the price, and the higher the price will be. So this is the idea behind the 4th point, which is an internal factor influencing pricing decision. The next one is about cost. Cost and profit are 2 dominant factors having direct impact on selling price. Here, cost include product development cost, production cost, and marketing cost. However, I could say the production and marketing costs are more important in determining price. It is very simple that cost and price have direct positive correlation. The next point of influence here is stages of product life cycle. Each stage of product life cycle needs different marketing strategies, including the pricing strategies as well. Pricing depends upon the stage in which company's product is passing through, whether the product is there in the introductory stage, or in the growth stage, or in the maturity stage, or which is moving towards death in the declining stage. So that is a matter of concern here. So I would say price is kept high or low, allowances or discounts are allowed or not, depend on the stage of the product life cycle. The next point to be considered here is brand image and reputation in market. Price does not include only cost and profits. Brand image and reputation of the company are also added in the value of the product. Generally, the company with reputed and established brand is enabled to charge high price for its marketing offers. The next influencing factor here is product line pricing. Some companies prefer to extend their product lines rather than reduce price of existing brands in face of price competition. If there is a need to come out with a brand with a higher price, they bring out a new brand in the same product line instead of cutting down the price for the existing versions of the product available in the product line. So the companies launch cut price fighter brands to compete with the low price rivals also. If there is a need to come out with lower priced brands, they are also launched so that the length of the product line is extended. This is the idea behind the eighth one. And there you can also add some more points like this particular aspect has an advantage of maintaining the image and profit margin of existing brands. By producing a range of brands at different price points, companies can cover varying price sensitivities of customers and encourage them to trade up to more expensive, higher margin brands. The ninth one is about category of product. Over and above cost, profit, brand image, objectives and other variables, the product category must be considered while setting price. Product may be imitative, luxury, novel, perishable, fashionable, consumable, durable, etc. Similarly, product may be reflective of status or position and prestige. Buyers pay price not only for the basic contents of the product but also for the psychological and social implications derived from the product. Let's look into the details of the external factors. External factors are also known as environmental or uncontrollable factors. Compared to internal factors, they are more powerful because they are uncontrollable. The first point to be considered here is demand for the product. Demand is the single most important factor affecting price of product and pricing policies. Demand creation or demand management is a prime task of marketing management. So price is set at a level at which there is a desired impact on the product demand. Company must set price according to purchase capacity of its buyers. Here there is a reciprocal effect between demand and price. That is, price affects demand and demand affects price. However, I could say demand is more powerful than price. So marketer takes decision as per the demand. Price is kept high when the demand is high and price is kept low when the demand of the product is also low. Price is constantly adjusted to create and or maintain the expected level of demand. The second point to be discussed here is competition. A marketer has to work in a competitive environment, irrespective of the product market in which he deals with. To face competitors or to defeat them or prevent their entry by effective marketing strategies is one of the basic objectives. Therefore, pricing decision is taken accordingly. A marketer perhaps formulates pricing policies and strategies to respond competitors or sometimes to misguide competitors. When all the marketing decisions are taken with reference to competition, how can price be an exception? Sometimes a company follows a strong competitor's pricing policies, assuming that the leader is right. If your brand is a follower, you try to follow the leader brand in the product market. Price level, allowances, discount, credit facility and other related decisions are largely imitated from the leaders. So this is about the understanding of the second point. The third point here is distribution channels. It implies a pathway through which the final products of manufacturers reach the end users. If the distribution channel is large or wider, price of the product will also be high, and if the distribution channel is short, the price of the product will be low. The fourth point of influence here is price of raw materials and other inputs. Obviously, if the price of the input for making a marketing offer is going up, the price of the marketing offer will also be. If the prices of the inputs come down a bit, there is a possibility for the marketers to bring down the price of the marketing offer and make it available for the consumers at an affordable or lesser price. So this is the idea behind the fourth one. And the fifth point is about buyer's behavior. It is essential to consider buyer behavior while taking pricing decisions. Marketers should analyze consumer behavior to set effective pricing policies. Consumer behavior obviously includes the study of social, cultural, personal and economic factors related to the consumers. The key characteristics of consumers provide a clue to set an appropriate price for the product. The sixth point of influence from the external factors is government rules and restrictions. A company cannot set its pricing policies against the rules and regulations prescribed by the governments. Marketers must set pricing within the limit of the legal framework to avoid unnecessary interference from outside organizations. Adequate knowledge of these legal provisions is considered to be very important for the marketer. The seventh point of consideration here is ethical consideration or codes of conduct. Ethics may be said as moral values or ethical code that govern managerial actions. Ethical values of marketers or the price setters in an organization play a vital role in price determination. If a company wants to fulfill its social obligations and when it believes to work within limits of ethics prescribed, it always charges a reasonable price for its products. Moral values restrict the managerial behavior. The next point of consideration here is seasonal effect. Certain products have seasonal demand. In peak season, the demand is high, while in slack season, the demand reduces considerably. To balance the demand or to minimize the seasonal demand fluctuations, the company changes its price level and pricing policies. For example, during a peak season, price may be kept high, and during the dull season, the price may be kept low. Discount, credit sales, and price allowances are important issues related to the seasonal factors. Then the ninth and the last point comes under the external factors which influence pricing decision is economic conditions. This is an important factor affecting pricing decisions. Inflationary or deflationary condition, depression, recovery or prosperity condition influence the demand to a great extent. The overall health of economy has tremendous impact on price level and degree of variation in price of the product. For example, price is kept high during inflationary conditions where too much of money chases too few goods. A marketer should keep in mind the macro picture of economy while setting price for his marketing offers. Thanks for watching this video. I hope I have explained the factors influencing pricing decisions in a very detailed way. Thanks for watching.